we're going to be discussing how mum and dad can help you get on the property ladder. This video is all about joint borrower, single proprietor. Let's get straight into it. Hello, welcome back to our channel and podcast. My name is Gemma, and here at WIS we talk about all things relating to money, mortgages and positive money mindset. So if that interests you, then be sure to subscribe to our channel and hit the thumbs up. It really helps with our YouTube algorithm and means that you won't miss out on any of our videos. On today's episode of Let's Talk Money and Mortgages, we have Ifti joining us. Ifti is a trained accountant and mortgage advisor who has been in the industry for over 10 years, and he is also one of the founding directors here at WIS. How are you doing today, Ifti?
I'm well, thank you. How are you doing, Gemma?
I'm doing really well, thank you. So today we are talking all about the bank of mum and dad. So there's a few different ways that mum and dad can usually help out their children get on the property ladder. We've got help with the deposit, sign as a guarantor, and be part of the mortgage as a joint borrower, single proprietor. So do you want to just talk us through those three main options? Just give us some more information.
Yeah. Okay. The first one which you mentioned is the most common one, where mom and dad gives money to their children as a gift. So that's the one that banks usually accept. So they sign something called a gifted deposit letter, and they give the kids a gift to help them with the deposit. So that's the most common one we see. The other two are quite underused, right? But those are two options as well. And one is where parents sign as a guarantor. And the third one, it's a joint applicant with the child, and then the parents don't go on to the deed. So that's called a joint applicant, sole sort of proprietor mortgage. So that's what it means, yeah.
Okay, so let's go into this joint borrower, single proprietor mortgage a little bit more and just like kind of delve in really what it means.
Okay, so if you look at the joint borrower, single proprietor, what it actually means is you apply for this mortgage together. So for example, let's say I want a mortgage, and let's say I'm earning 40,000 per annum, right? So based on a 40,000 per annum salary, the bank will probably offer me 4.5 times my income. Now that works out to about 180,000. So if I need to borrow, say, 250,000, I am short, right? So because I'm short, I can go to my parents and say, look, I'm short of, say, 70,000 to make it 250. Could you join in my application? So together, we can apply for the mortgage, but the big difference here is that even though the parents are part of the mortgage, they are not going to be on the deed or the land registry because they are only going to be part of the mortgage. That's why it's called a single proprietor. So I'll be the single proprietor for the application. So they are only helping me out with the affordability to make it work.
Right. So what does that mean legally for them?
Yeah.
The parents?
So legally, they are responsible for the mortgage. They're part of the mortgage for sure, but they're only not part of the deed, right? So on the deeds, it's only my name. So I'm responsible for everything, but they are only helping me out with the mortgage. But obviously, if I default, they have to pay, right? So they are responsible for the payment of the mortgage. So effectively, they are still part of the mortgage, right? So they are still answerable to the bank. But on the deeds, it's only my name, right? Because that's the ultimate goal. Because, as I say, progress in my career over a period of time, the idea is for me to own the house myself, right? And they will sort of slowly back out of the mortgage. That is the whole idea behind it.
Okay, cool. So how does that differ then from a guarantor mortgage?
Okay, so guarantor mortgage, that's again a popular one, comparing the two. But with the guarantor mortgage, they just provide a guarantee. So if case I default, they pay. So they don't go onto the proper mortgage itself, right? So it's only a guarantee that they provide. In case I'm short and I can't pay off the mortgage, they will chip in, right? So that's kind of what the difference is. So legally, there is a big difference between the two.
And what about, with a guarantor mortgage, if you defaulted on the payment, would they still be held responsible for the payments or not?
Yeah, because they have signed as guarantors, right? So therefore, they are responsible for that. Yeah, that's right. Yeah.
Okay, so they're just not part and parcel of like the application of the mortgage as such?
Yeah, they are. They'll be assessed as well, but they're not part of the mortgage. They only sign up as a guarantor. Whereas joint applicant, single proprietor application, they are definitely part of the mortgage, right? Their names are on the mortgage.
Okay then. So are rates then higher with joint borrower, single proprietor mortgages?
Not that I'm aware of. most banks offer the same rates to the customers, irrespective of what their type is. If it's a single applicant or if it's a joint applicant with this kind of arrangement, the rates don't change. But this is where you find a problem: is not all banks allow you to do this. So there is only a selected number of banks who allow you to do that. So therefore, if there's a bank who offers 1% and another bank offers 1.1%, but they allow you to do this, you might end up paying a little bit more, right? So that's where you have a problem, because not all banks allow you to do this. But the good thing is a lot of high street banks have come to this space, so which means it's making things a little bit more easier. So there are more options now. But there are a lot of building societies who do this as well. So there is quite a few lenders to choose from, but not everybody offers it. So therefore, it might be a little bit expensive in that sense, yeah.
Okay, so then how does stamp duty work? So obviously, if you're a first-time buyer, if you're buying a property under 300,000, there's no stamp duty. But then how does it work if you're doing a joint borrower, single proprietor?
So yeah, that's the beauty of this scheme as well, because quite often your parents already own a house, right? So that's kind of what it is. The parents are sort of helping out the child buy the house, right? So with this, what happens is the parents don't go on the deed, right? So because they don't go on the deed, it's the child who's responsible for the stamp duty, right? Because it's only the child's name which is on the deed. So that's the beauty of the scheme, right? Because otherwise, if it's just a normal application with a joint applicant with your parent, if they already own a house, you pay 3% additional stamp duty. But in this case, you don't pay 3% additional stamp duty. So that's the beauty of the scheme, right? So it helps them buy the house, but with no additional stamp duty.
The next question that we've got here is, does the age of the parents matter if they're going to be part of the mortgage? Often if they're coming up to retirement, that could be problematic. Like, how does it work?
The answer is yes and no, right? So yes, the age does matter because you're a joint applicant. There's a lot of banks say, you can only go up to 70 years of age, right? So if I'm 40 and my parents are 60, quite often most banks will allow you to go only up to 70 years, right? So the maximum duration of the mortgage will only be 10 years, right? But saying that, there are some banks in this space who allow the parents to go up to 80 years of age, right? Subject to meeting certain criteria. They are comfortable so long as the parents are having a job which is not very labor intensive, right? They are comfortable with jobs where you use your skill sort of thing and work. So they are comfortable with that sort of thing. So if you do have a case like that, you probably want to speak to an advisor, because the advisors will know which kind of banks will accommodate this, right? And obviously, like I said, there are some criteria around it. So if you can fulfill those, that works for you.
And what about parents' pension? Does that get taken into consideration?
You can, but not necessarily, right? So yes, pension can help. But at the same time, if you're at that age, anyway, you will have some pension income, right? Some of the banks I work with, they're not too worried about the pension element. They just want to see whether parents can work during that time. So if they're in a line of work where they can continue to work till 80, they're okay. But like I said, pension does help, right? But it's not necessarily what they're looking for.
Okay. So are these mortgages more expensive then compared to the conventional ones?
Yeah, I think I answered part of this question, but there might be some additional legal fees you have to pay because it's a different type of mortgage, right? But apart from that, there shouldn't be much of a difference, right? Because stamp duty you do save. When you compare it to a normal joint application, you do save on the stamp duty. The interest rate might be a little bit on the higher side because the cheapest provider of this particular service may be a little bit higher than the cheapest provider of a generic mortgage sort of thing, right? But apart from that, it's probably a little bit of legal fees might go up by a little bit, but I don't think it's going to be too much anyway. Yeah.
So
it's
the
all
product fees are about the same as well?
Yeah, it's about the same. So there's no discrimination as such, right?
Okay. So, Ifti, do you have any more tips for people that are going to use the bank of mum and dad to help them get on the property ladder?
Yeah, I mean, this is a very interesting area. Obviously, the average house prices in the UK has gone up over a period of time. I mean, I've read reports which say that it's gone higher than what the salary rates have been going up by, right? So we can see quite a lot of gaps appearing between what you can borrow a few years ago and, the house price sort of thing, right? So we can see those gaps. So I think it's always best to speak to an advisor because these kind of options are out there. A lot of people don't know about these. They only think, okay, parents can only give us a deposit, right? But that's not true, right? Because there are other ways that you might be able to work this out. So it's probably best for you to speak to an advisor on this area, because these options are out there. There might be schemes which you've not even thought about, right?
All right, well, thanks, Ifti, again for some great advice. I'll just do the usual reminder that these points may or may not be applicable to everybody, so please do check to see if they are suitable for you. And if you don't have an advisor, I will leave our WS contact details below, as we are always more than happy to help. A little reminder that as a mortgage is secured against your home, it can be repossessed if you do not keep up with the mortgage repayments. Thank you once again for joining us today. We'll be back next week with another episode of Let's Talk Money and Mortgages. Have a great day, stay safe, and we'll see you again soon.